Well, good morning, everyone, and welcome to the JMM and Tribeca Nuclear Energy Forum. I'm Jane Morgan, your host today. For those who you know, this is our third JMM and Tribeca Nuclear Energy Forum. You can probably tell I'm very passionate about the space, and particularly when it comes to energy. But I think that's enough for me. There's probably no better person to even talk about this than our keynote speaker. So, our keynote speaker today we'll be covering a market overview and deep dive on the nuclear and uranium investment thesis, which of course is Mr. Guy Keller, the portfolio manager for the Tribeca Nuclear Energy Opportunity Strategy. But as I mentioned, so Guy does manage the Tribeca Nuclear Energy Opportunity Strategy, which is now in year 8, I think. Is that right, Guy?
Yep.
And of course, is the only fund in the Asia Pacific region which is dedicated entirely to the global uranium and nuclear sector. So, with that, I'd love to introduce you to our keynote, Mr. Guy Keller.
Thanks, Jane, and thanks everybody for joining today, and also to those of you who will watch this on a replay at a time in the future. It's great to be back here. It's a very pivotal time, as Jane said. There's obviously a lot going on in broader markets, especially around the Middle East. However, one of the really key things to remember here about what's going on in the Middle East is this notion of energy security. And this is two words you're going to hear from me a lot in the future. And I've been harking on about it for a while now already, but it's just brought that forward. Energy security has emerged as a global geopolitical and economic priority. Not only have you got governments, but you've got corporates and consumers all pushing for reliable, affordable energy supply. And these geopolitical risks have just highlighted that. When we look back on, I mean, history doesn't repeat, but it often rhymes. We look back at the oil crisis in the 1970s. That sparked a large reactor build program in the West. I think over that decade of the 1970s, France, England, the United States, as leaders there, built, I think, 54 to 60 reactors over the course of that decade in response. And remember, there's a very key difference this time is that last time that was an oil shock. This time we also have a gas shock. And, oil is not as relevant in the provision of electricity, but gas is, especially into the Asia basin. We believe there's going to be some structural overhang from this conflict that will be around for months, if not years. And already we're seeing governments who aren't necessarily been as vocal as, say, the US on nuclear power as part of their energy policies, especially in Asia with Korea and Japan, more vocally stepping up into that realm. So it's a decade-long transition or decades-long transition, and we're in an environment now where we fully expect the West to be announcing more. So I'm also going to share my screen as I'm talking, which is multitasking, announcing more nuclear capacity builds on top of, I mean, we have to remember here, we've already got 70 odd reactors being built across the world that will be connected between now and 2030, further exacerbating the uranium supply deficit that we're going to talk a little bit about. Right. So, as Jane said, we've been around for 8 years. I think for those investors been since inception, they've seen about a 675% return on their money over those 8 years, which is about 31% per annum. You can see their last calendar year was 45%. The fiscal year being from July 1, 25, was up about 25%. And despite the volatility this quarter, which has been brutal, we're still up around 10% on the quarter. So that was largely thankful to locking in some good gains in January. We run not only just a uranium exposure, but have pivoted. The reason we call this nuclear energy opportunities 8 years ago was because I identified that there was going to be investment opportunities in the nuclear fuel cycle, in the generation of nuclear electricity, and also now what we're seeing a lot more of is the small and advanced modular reactor designs that are becoming closer and closer to commercial reality. So you can see here at the moment about 36% of the fund is in what we're calling nuclear innovation. That's been as high as 50. To put it into perspective, about 2 years ago, it was about 5%. So we've certainly increased that with conversations around data centers and tech companies being a new customer. There's a slide here on how we differ from the ETF. I get this a lot. Why would I pay you fees when I can invest in the ETF? The ETF's a passive vehicle. It cannot short or hedge. It can't lever the portfolio into rallies. It rebalances semi-annually, and what you see in a lot of North America, especially, has been M&A for the sake of building market cap to get themselves into the ETF. We're an active manager. I basically cover everything radioactive within the firm here. It's 90% of what I do. We can short, we can use derivatives to hedge, and as I said, we're across the whole universe from exploration, kicking rocks around in a desert somewhere, all the way through to the nuclear fuel cycle, electricity generation, and advanced reactors. Just a short slide on the fund. You can see that later at your leisure. Now, this is an example of this photo is a very powerful photo because this is a Susquehanna nuclear plant that came out of administration in 2021. Announced back then that they were going to build a campus for crypto mining alongside their nuclear power plant in order to take advantage of the power demands of crypto. They were one of the first to do a deal with Amazon Web Services to build a data center campus, and not crypto mining, at prices that were 2.5 times the current wholesale price of electricity. So it was the emergence of what we're seeing here. In the past, we've had flat electricity growth in the US and Europe. Most of that growth has come from India and China and the emerging markets. That was the future demand for uranium and nuclear power was largely China and India's reactor build programs. But now we're seeing, because of this data center, the AI, the hyperscalers, electrification of transport, electrification of industry chasing decarbonisation. You've seen now electricity demand kicking up in both the US and Europe for the first time in decades. And this is obviously feeding through to the more medium to longer term demand for nuclear power. Global tech companies, what we've missed in the past, in the 1970s, it was governments building those 54 reactors, taking the construction risk. They got better at them over the decade of the 70s because, again, when you build more than one thing, think of IKEA flat pack furniture. The first one you hate building, by the time you're on the third or the fourth one, you're an absolute expert in IKEA flat pack furniture. The difference now is that we've got this cashed up, motivated end user that's pushing for the investment into nuclear capacity, and it's not just in the small modular reactors. It's in capacity re-rates for existing reactors. It's for reactor life extensions. It's for turning on idled reactors, which I never thought we'd see in the US and Europe's probably to follow as well. It's the completion of uncompleted reactor construction. And then obviously we've had some massive announcements with $80 billion in the US to build up to 10 AP1000 Westinghouse reactors in the United States, which we fully expect for further commitments this year to be coming from that. It's very easy to sit here in the bubble of Australia and our domestic energy policies, which we're not going to get into because you'll see steam coming out of my ears. It's very easy to forget that there's now 38 countries that have pledged to triple nuclear capacity. In fact, that was another 5 countries recently that added to that pledge. We've seen 14 major banks also pledged that tripling nuclear, and that also includes the World Bank getting rid of a decades-long ban on funding new nuclear energy projects. It's all well and good that you've got these data centers and large energy users also pledging to triple nuclear, but as you said, without the banks to help facilitate those financing of tens of billions of dollars. So this is all happening in the background. And again, just this global picture, governments across the world extending, building, and investing in small modular and advanced modular reactors, refurbishing existing reactors. It's happening everywhere. It's not going away. Energy security has brought this slide, even more to the forefront of governments' thinking as they look to secure electrons going into the future. Uranium. There's been a lot of money. There's been a lot of money and governments focused on the midstream and the downstream. So there's been a lot of talk about conversion and enrichment bottlenecks. Conversion and enrichment is where the yellow cake that you see on your screen goes through a nuclear fuel cycle before coming fabricated fuel rods to be put into a reactor. That used to be an 18-month process. It's now closer to 3 years. And that's largely because of legislated bans coming in at the end of 2027 in the United States for no more Russian fuel, and with similar moves in Europe and other parts of the world. The money has been focused in the last 2 years to fix that. And they were not necessarily bottlenecks on physical bottlenecks. They were bottlenecks on capital being deployed, and that capital wanted certainty of future business. So they wanted the utilities to sign contracts to say, when we build this extra conversion and enrichment capacity, there's actually going to be a market for it. To take away the risk of Russian material coming back somehow, which we see as a very small probability. That's been solved. So the capex is being delivered, and that construction is starting. The real bottleneck is coming from uranium, where global governments have included uranium in the critical minerals lists, but there seems to be an idea that the market is going to take care of uranium supply, that the market will fund that and finance it, people like me, to get these uranium miners into production. And we're seeing so far that we're not at prices that are incentivizing that. We've got a primary mine supply deficit already. We've had it for a decade plus. That deficit has been filled with secondary supply, so kind of like recycling, but a little bit of nuance in the fuel cycle, which is only going down for various reasons, mainly because there's demand in the fuel cycle now. So there's less idle time in which to produce some secondary. So that's going down, and it's been inventory depletion. So the great thing about inventory is once it's consumed, it doesn't regenerate. And so, we've filled that gap since then, that primary mine supply gap. We're now going into a period where, as I said, we've got 70 odd reactors, which means there's an additional 40 odd million pounds of uranium in a 200 million pound demand market at the moment being added to that demand equation. When you think about 40 million pounds, by 2030, NextGen should be up and running, and they'll be doing a maximum output in their in a year of 30 million pounds. Their average run rate is going to be less than that. So that world-class asset is only going to be fulfilling the demand for the reactors that are currently being built. So that not even the future reactors that China is going to start next year doesn't include what the US is going to be doing. So we can sit here and we're seeing that China and India are moving already on the uranium. India's just signed massive contracts with both Kazatomprom, the largest producer of uranium out of Kazakhstan, and Cameco, two massive multi-year purchase programs. And that's to secure uranium for reactors they haven't even completed yet, and some that they haven't even started building yet. Whereas the West is sitting back thinking that there's going to be this magical supply response. And can I tell you, it's not coming. to get that uranium, you need to start today. You need to be making these investment decisions today to bring that supply in because a lot of these projects, I mean, a 2 to 5 year builds before you're even getting any yellow cake out of the ground. That's the WNA. Um, there's no way the lower scenario is relevant anymore. We're somewhere between the reference and the upper scenario, and we've got the great unknown as to what is small modular demand going to look like from 2030 onwards. And I can tell you one thing, we're all going to get that demand wrong. We're going to be too light. And we've got some geopolitical risk around supply of uranium. And then you've seen this other slide as well, that nuclear fuel prices. So it's not just uranium that's tight. The fuel prices are showing as well that this is a real problem, not just a uranium problem. It's the whole way through the fuel cycle. Um, I just want to touch on. Oh wow, I'm actually going really well for time. Who would have thought? So yeah, I just want to touch on um, the price and the market at the moment. It's very easy to point to uranium prices. The spot price is $85, somewhere thereabouts, $80 to $90. The term price, $90 to $92. Again, both of these price indicators are irrelevant. Spot gets moved around on a whim, often without trading. And the term price is a backward-looking price. So it's basically saying, reporting the lowest possible price that could have transacted a month or two ago. Um, the uranium market ignores the future value of uranium, largely because it doesn't suit the utilities too. When we look forward at $90 term, we're projecting a forward curve out to 2030 of about $115. But the market is not pricing future pounds on that. And so you're not seeing much incentive to bring those pounds to market because what we've seen in all mining operations, especially since COVID, is you've seen cost inflation coming through. And it would be naive to think that we're not going to continue to see cost inflation in mining projects going forward, especially with the repercussions of the Middle Eastern conflict, and not just for crude oil prices, but for diesel through the refining process, for gas in the electricity provision, but as well is sulfuric acid, which is a very meaningful product in a lot of mining and including uranium mining. So it's going to get harder. Um, there's We've seen some projects come to market last year that were all restart projects. Most of those are through most of their teething issues. But again, the total pounds is nowhere near what's required. Nowhere near what's required. So I might leave it there. I mean, one of the things about our fund is as we were saying, we're a global fund. I've been in this space for more than 8 years now. As Jane said, probably the only dedicated, well, we are the only dedicated manager in the Asia Pacific region, and one of only a handful globally that's got the IP to progress through this. You are going to hear from some very good and interesting ASX listed uranium stocks. We're kind of in the middle of the market cap stack here, anything from, I think, from 100 to 300 million. From a producer coming through a restart process now and getting through most of the issues that happen with restarts and ramp up. A really interesting development project in Alligator. I was lucky enough to be out there yesterday with Andrea and the team, looking at their field recovery trial, and then a very prospective explorer in DevEx, who've got a very good land package up in Northern Territory, and I've been up there quite a few times, kicking rocks up there with Brendan and the exploration team, and another exciting prospect. So hopefully you'll enjoy that, and I haven't gone on too long, long enough so that you can watch this video on your commute into work.
Guy, I'm very impressed actually. That's probably the first time you've actually stuck to a time frame, so well done.
Yeah.
I might actually just get you to stop sharing your screen there, and while you're doing that, I encourage webinar attendees just to use the Q&A function, which can be found at the bottom of your Zoom screen. If you do have any questions for Guy, all the presenters coming up here today. Guy, I'm going to jump into it first up. So we've spoken about this and you had a slide in your deck, but I guess the single most important demand side development in nuclear is obviously AI. Just want to pick your brain a little bit here. So Microsoft, the Googles, the Amazons of the world, walk us through exactly why the shift might towards be more nuclear in that case. Probably covering fundamentals first, and then perhaps potentially going a little bit more specific, by walking through how you approach it at Tribeca as part of your strategy.
Yeah, so AI data centers require firm, reliable baseload electricity, and they're requiring a lot of it, a lot more. I mean, it's been a massive exponential curve on these tech companies talking about 10 megawatts of electricity demand, and now they're talking gigawatts of electricity demand, and that's been in a really short period of time. They are extraordinarily switched on as to how electrons can be provided to them, electricity can be provided to them. They know electricity grids, transmission sources better than most industry experts and governments because they're investing hundreds of billions of dollars into the data centers, into these machine learning, into hyperscalers, into all of these things. And there's no way that they're going to allow that to become unstuck by being short of electricity. The US has been the most aggressive and visible because most of these tech companies are based there. And the US has got the advantage that they've got a phenomenal natural gas network, phenomenal pipe structure to move that gas around in order for industry and electricity. However, with that backdrop, they are still aggressively pushing nuclear because they see the 60 to 80 year reliability of that and have realized that again when they can control and lobby governments to protect the whole fuel cycle, then energy security, geopolitics, get cancelled out to a large extent. So they've been a really big driver. And again, not only do they have checkbooks, but they have the political ability to lobby both sides of the street. So it doesn't matter who's in charge. And you've seen that with deregulation at the Nuclear Regulatory Commission. You've seen that in rules getting through on the electricity grids in the United States, which are normally bureaucratic and take months and years of back and forth. You've seen some really big changes happen there. And the reality is we can sit here and get a little bit worried about, companies are cancelling and some future capex and they're not doing as many data centers and what have you. Just on the current announced and committed projects from these companies, the electricity sector cannot keep up with what's currently planned. So we kind of needed a little bit of a break, if you like, from that, so that we can, build these supply chains and start responding. So that didn't worry me. What it gave me was an opportunity because with this and also the general risk off because of what's going on in Iran has provided yet another opportunity to pick up some really good value, not only in uranium companies, but also in some of these nuclear technology related plays as well.
Yeah, absolutely. Look, I think I was lucky enough to actually be involved with that presentation that you did with Craig Scroggie, who's obviously the CEO and managing director of NextDC, that data center. And it's baffling to sort of see that we're not really there yet, and what's coming for the AI sort of sector is very interesting. But so look, I think let's move on from AI and let's look at the sector as a broader sort of thing. What other key drivers are really sort of underpinning that uranium demand from here?
Well, as I said, I mean, what we're seeing as well as a result of all of this downstream desire for more nuclear capacity is that we're seeing that that the old way of utilities contracting is starting to become old and outdated, and they're going to get to a point where they're forced into more aggressive contracting by the end customer, by the Microsofts and the Googles and what have you. And the difference this cycle is that at the end of the last cycle, about 2009-10, we saw the emergence of China coming in as a big contractor of future uranium. This cycle, we're seeing China and now India come in early to that equation. So they're well ahead of the commercial reactors, not only in Europe and Asia, but also in the United States. And they are securing a huge quantity of uranium out a long way and catching these utilities a little bit off guard. So, I think Cameco has a brilliant slide out to 2040 where they're talking about 2.4 billion pounds, billion with a B, pounds of uncontracted uranium from the 430 odd reactors in commission at the moment. There is going to be a moment where, and again, some people in the industry have alluded to the fact that maybe Microsoft just bypasses the utilities and comes directly into the uranium market themselves. We've seen that happen in other commodities like lithium and what have you. It wouldn't surprise me if that happens. And for them, a $90 price is kind of irrelevant because they need to make sure that you can't thrift uranium. You can't replace it with anything. To run nuclear energy, you need uranium. And, for them, if they're spending $140 a megawatt hour on wholesale electricity contracts out for 20 years when the price is 40, again, they're not going to quibble over $90 or whatever. They're going to say, what is the price to incentivize meaningful supply to come to the market? And we're going to lock that up.
Well, let's actually do the next question. Let's do a deep dive on that. And again, you've sort of referred to this in your slides in the session. What share of the global electricity generation could nuclear realistically capture by 2040?
Yeah, I mean that's a really good question. So the current constraint obviously is um, building gigawatt scale reactors. The Chinese are doing it in sub 5 years and on budget. The Koreans proved by the fourth reactor in the UAE that they can do it around 5 years and relatively on budget. But these are large, very large engineering and construction projects. They require heavy forging, they require long lead items, and a big and well oiled supply chain. The difference that you're going to find post 2030 is these small modular reactors and advanced designs are going to become commercialized. It is coming. It's coming a lot faster than anybody thinks. The first of a kind are being built right now. Supply chains are being built out. There's deals being done left, right, and center that the broader market misses because they're not in the weeds. And it's all about securing the supply chain for the modularization of these things. And that's going to be the game changer to really boosting that share of nuclear power. And I think again it goes exponential in the after 2030, which again is going to require investment in uranium to supply that.
Sorry, bear with me. There's quite a few coming through, and there's quite a few coming through just on the SMR market. You've kind of spoken. This one says, can you touch on the SMR market and how you think that affects uranium demand in the future? But just one even more specifically that's asking, is it not possible to adopt the technology used in submarines?
Well, I mean, so the technology that small modular reactors and advanced reactors are utilizing is not new technology. It's old science, old physics. We've known about it since the 1950s and through those Cold War decades where not only the United States, but numerous other countries had test labs exploring molten salt bed reactors, fast breeder reactors, high temperature gas cooled reactors. And we've always known about the small modular reactors, the pressurized water reactors are just smaller versions of what we're currently building. It was just that there was not a commercial pathway to that. it was more cost economic to build 2 or 3 gigawatt scale in one site because it was large scale grid power. So it actually the submarine technology is exactly the same. It's just using a much more highly enriched uranium than civilian reactors would use. So they've proven that it's possible to do it, and they're very good at doing it. There's a huge amount of expertise, especially in the United States, around that. So that's all going to lend to making the small and advanced reactor industry easier. The bottleneck as well has been regulations, and that's dramatically changing. We've already seen a number of designs in the US with record times to pass through, and I'll be in the United States in May and going to see George and the Peninsula Project, but I'm also going to try to get across to the other side of Wyoming and have a look at the Bill Gates-backed TerraPower reactor that's being built there in an old coal-fired power plant in Wyoming. So I'm going to see if we can do that. So it's already happening, and as I said, regulations across the world are fast tracking that to allow this to come to market much more quickly.
Thank you, Guy. Again, there's quite a fair bit of interest here on sort of the SMR market. Um, there's one actually that just popped up. So, what's the bear case the market is ignoring? Is there a scenario where grid scale battery costs fall fast enough to close the baseload gap before any SMR reaches commercial deployment?
We need grid scale battery technology to be commercially viable and scalable. And even if we do, this is not a nuclear versus renewable plus battery and or gas and or fusion and or whatever. Everything's required. I mean, we've not seen the compound, the CAGR growth in Western grids for decades. We just haven't seen this, and most Western grids are old and aging, and been flat to declining electricity years. So just the sheer pull of what's coming through, not only from tech, but also from electrification of transport and decarbonisation of industry. We need all of that technology, and we need all of those supply chains to be built. What's it good for? It's fantastic for all mining operations of these critical minerals that are going to be required not only for nuclear but for batteries and everything else. So fantastic space to be in nuclear, uranium, and broader resources as we are here at Tribeca.
Oh, thank you, Guy. Sorry, we're getting quite a few questions here. Thank God you actually wrapped up your presentation pretty quickly for once. Okay, so we've got one here that just asks about your approach at Tribeca in particular. So this person asks about what on the ASX is standing out to you, but then also specifically asks whether Tribeca avoids any certain jurisdictions within the energy sector, if you're able to comment on that at all.
When it comes to uranium, it's very hard to avoid jurisdictions because there's uranium in obviously Canada, Australia, Kazakhstan, but there's also uranium in far-flung African nations as well, and South America. So we kind of I mean, we even still have exposure in Niger, despite there being a military junta kick in a few years ago. So, I mean, there's just different ways of dealing with those jurisdictions and thinking about them and how we scale our exposure in some of those jurisdictions. There's a few that we won't touch at the moment, but that's not to say that we won't look at them again if things were to change. But obviously, the desire is if you can have exposure in Australia, United States is a fantastic opportunity because there's just so much noise being made from Energy Secretary Chris Wright over there, as well as the Trump administration, around critical minerals and US and allied sort of supply, that eventually those words need to translate into actual action and or money and or some sort of floor pricing or whatever it is they're going to do to actually secure that. So there's some more favourable jurisdictions on that basis, just around politics.
Okay, Guy, I'm mindful of time here, but Got a couple more I'll just quickly run through because I do know that George has to run to a flight. But so this one is specific about the technology and processes itself. So, what's your opinion on fusion? Is this the space that you're looking at?
Yeah, look, I mean, we do have a very small private exposure to fusion technology in the fund. It's largely a little bit of a placeholder, and there was a lot of queries about it. It's a technology that is always been a decade away for a number of decades. There's probably more eyeballs and more capital being deployed in that technology at the moment, but I don't see it skipping the queue necessarily with respect to everything else going on. There's still some quite big challenges that need to be cracked, and everyone's saying quantum computing may help that and what have you. But we'll see. I mean, we're not ruling it out, and as I said, it would be a technology that we would welcome if it was able to be commercialized and scaled because it's going to be needed.
Okay, Guy, wrapping up just quickly. You and I have obviously done this for like this is our third time now. We're both big fans. Where do you think the market is underestimating the opportunity when it comes to nuclear energy and in particular uranium?
I mean, across the whole spectrum. I mean, there's a reason why we're focusing today on three companies, and for full disclosure, the fund owns all three, obviously. But why we're focusing here, and it's because what I'm looking for at the moment in uranium, especially, is companies that are doing things, companies that are active. We've had far too long of companies just sitting back and trying to ride the uranium beta from $20 to $80 on price, but not necessarily progressing things because I think the next few years, those companies that are providing a solution are going to be the companies that get the bulk of the attention from these utilities when they start getting more aggressive and or the end customer if they bypass those utilities. And so that's where I think the opportunity is. The 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 other great thing about this sector is there's still so many generalists that fly in and out of the sector on macro whims that produces that volatility. And whilst it's not nice to stomach when it goes wrong for you, it does provide you, when you're thinking a bit more medium term, it provides you some fantastic opportunities to top up or reallocate into companies at levels where you kind of thought when everything's running, like January, you're kind of thinking, wow, am I going to get a chance to buy these things these stocks at a good price again? Maybe not, but then it presents itself and you pin your ears back, and that's what we've shown over 8 years is that these opportunities have been great times to get into the fund and also a great time for me to continue to flex up some capital.
Absolutely. And the fund is performing very well again for the eighth year. So congratulations. And
Yeah.
thank you again for your time. Guy, if we've missed any questions for Guy today, please feel free to reach out either on the Q&A function here or just via email at info@janemorganmanagement.com.au. Guy will still be here for the rest of today's webinar and be able to provide some insights on the companies that are presenting today. But Guy, thanks for your time.
Thanks, Jane, and thanks everybody for tuning in.